Real estate investing. Real estate investing involves purchasing properties to generate income, build wealth, or both. This type of investing can take many forms, from buying rental properties to investing in real estate investment trusts (REITs). Here's a breakdown of some common real estate investing strategies. 1. Buy and hold. Objective: generate long-term wealth through property appreciation and rental income. How it works: you purchase a property and hold it over the long term, earning rental income and benefiting from property value appreciation. Over time, the mortgage is paid down by tenants, and the property's value may increase. Pros: steady cash flow from rent, potential for property value appreciation. Cons: requires significant capital upfront, ongoing property management and maintenance. Example: buying a single-family home, renting it out for steady cash flow, and selling it years later for a profit. 2. Fix and flip. Objective: buy undervalued properties, renovate them, and sell for a profit in a short time frame. How it works: you purchase a property that needs repairs or updates at a lower price, renovate it, and sell it at a higher price. The goal is to make a profit from the increase in the property's value. Pros: quick profits if the renovation is successful, potential for high returns. Cons: high risk if renovations go over budget or market conditions change. Requires expertise in home renovations. Example: buying a distressed property, renovating it with modern updates, and selling it for a higher price. 3. Rental properties. Objective: generate consistent cash flow from tenants while benefiting from property appreciation. How it works: you buy residential or commercial properties and rent them out to tenants. The tenants pay rent, which covers your mortgage and other expenses, leaving you with positive cash flow. Additionally, the property may appreciate in value over time. Pros: steady passive income. Property value may increase. Tax benefits, e.g., depreciation, deductions. Cons: management can be time-consuming. Risk of vacancies. Property maintenance costs. Example: owning a multi-unit apartment building and collecting rent from tenants. 4. Real estate investment trusts (REITs). Objective: invest in real estate without owning physical property. How it works: REITs are companies that own and manage real estate portfolios, such as commercial buildings, apartments, or hospitals. Investors buy shares of the REIT, which generates income through dividends from the properties owned by the REIT. Pros: liquidity, can be traded on stock exchanges. Exposure to real estate markets without managing properties. Cons: limited control over the investment. Market volatility affecting share prices. Example: buying shares in a REIT that invests in office buildings, shopping malls, or residential complexes. 5. Real estate crowdfunding. Objective: pool money with other investors to fund larger real estate projects. How it works: through online platforms, you can invest alongside others in larger real estate deals, such as residential or commercial developments. Investors typically receive returns through rental income or property sales. Pros: low entry point. Access to large-scale commercial real estate deals. Cons: fees can be high. Less liquidity compared to REITs. Example: investing in a real estate development project in an emerging neighborhood through a crowdfunding platform. 6. Commercial real estate (CRE). Objective: invest in commercial properties like office buildings, retail centers, or industrial spaces. How it works: similar to residential rental properties, but instead of homes, you buy commercial properties to lease out to businesses. Commercial leases tend to be longer term, offering stability but also requiring more upfront capital. Pros: higher rental income. Long-term leases often provide stability. Cons: requires more capital, higher property management responsibilities. Example: purchasing an office building and leasing spaces to businesses. 7. Short-term vacation rentals, e.g., Airbnb. Objective: generate high returns by renting properties on a short-term basis to travelers. How it works: you purchase property in a desirable location and rent it out short-term through platforms like Airbnb or VRBO. The goal is to earn higher rental income than traditional long-term leases due to premium pricing for short stays. Pros: higher rental income potential. Flexibility to use the property yourself. Cons. Property management can be time-intensive, subject to local regulations and market competition. Example: purchasing a beach condo and renting it out to vacationers during peak tourist season. 8. Wholesaling. Objective: earn profits by securing properties under contract and selling the contract to other investors. How it works: wholesalers find distressed or undervalued properties, get them under contract, and then sell the contract to another investor, usually a fix-and-flip investor, for a fee. You never actually own the property. You just facilitate the transaction. Pros: requires little capital up front. Fast turnaround. Cons: relies on finding deals and a network of buyers. Minimal control over the final outcome. Example: finding a house in need of repairs at a discounted price, getting it under contract, and selling the rights to purchase the property to a fix-and-flip investor. Key considerations in real estate investing. Location. The location of the property significantly affects its value, rental income potential, and long-term growth. Market research. It's important to understand the real estate market conditions, whether it's a buyer's or seller's market, interest rates, and local demand for rental properties. Property management. Managing properties can be time-consuming unless you hire a property manager. This includes handling tenants, maintenance, and legal issues. Financing. Real estate often requires significant capital, either through loans, lines of credit, or cash. Mortgage rates and terms can significantly impact profitability. Risks. Real estate investing carries risks such as property damage, vacancies, declining property values, or changes in market conditions. It's crucial to assess the risks and have a strategy in place to mitigate them. Final thoughts. Real estate investing can be an excellent way to build wealth and generate passive income, but it requires careful planning, research, and management. Whether you're buying physical properties or investing in REITs, understanding the market and having a clear investment strategy is key to success.